And we have new participants who are not members of BVA. I request, like, if you register as a BVA member, you will get, you will become the BVA member in WhatsApp group, as well as you can attend second Saturday and fourth Saturday sessions without paying any amount. And I request members to send topic list. If you are looking any special topics or which you want to know, then we can arrange the sessions. Maybe you can share it to Shilpa or Vijaya. Maybe you can see that the faculty for that. And also, like, Bangalore Valor Association is planning to conduct one session in January. It is 4th Saturday, like 28th January 2023. It is like one-day program, physical program, where we can discuss all the topics like valuation challenges, what we had in the month of August. Same thing, we're going to have one more session. I request members, okay, to plan accordingly, because last time it was very short time and members not able to attend. This time we are giving in advance. I request members to plan. It is one-day program, morning to night, like 8 o'clock till 8 o'clock dinner. And we will share, okay, the details in the future. And also I thank, okay, the management committee of Bangalore Valor Association, and also like we started a new committee as a profession development committee, where we are going to do some research, and we are going to share some formats, reports, and calculation sheets, which provide, okay, it is a solution to the DCF or other methods, which will helpful to the new valuers who has completed this one. Okay, it will be helpful to them. And also, like, we will share that newsletters or research depending upon the topics. I thank Shilpa for arranging and coordinating this session with Rajesh, and also I thank Vijaya for interacting with the members and to show, to provide all the facilities. Now I request Shilpa to take over and to start the session.
Good morning, everyone. Today's our speaker is Rajesh Yanamandram. He's a chartered accountant with over 14 years of professional experience in Big Four, ex-Deloitte, and industry pharmaceutical engineering. He specializes in the areas such as statutory audits, internal audits, direct and indirect tax, advisory, business valuation services, internal control over financial reporting and SOX, ERP implementation, Ind AS, IFRS implementation, and management advisory services. I'm very happy to share that, we had 15 valuers who separately, requested for registration, for this separate program. This shows that, how many new members are interested to listen to this topic. Over to you, Mr. Rajesh.
Thanks, Shilpa. I'll just share my presentation. Can you just confirm whether it is visible? Will you be able to see?
Yes.
Will you be able to see Shilpa?
Yeah, one.
Yeah, business valuation update.
Yeah. Types of distribution is coming now.
No, another file.
Yeah, second file also we can see.
You can see?
Yeah.
The business valuation update.
No, we can see only types of distributions.
Okay. Now you can see.
Yeah, business valuation update.
Yeah. Before starting the session, so I would like to know how many valuers is using the Monte Carlo valuation methodology in the valuations. So did anybody is applied in the practically? Just want to know just where are we on this front? Can you just put it in the chat box, yes or no? Okay. Actually, there was a survey has been conducted by the business. Okay, I understood. Most of them, it is not applied. And that is also his survey also says. So there is a business business valuation resources has been done survey in the past, somewhere in 2015. So I just maybe that is also is relevant at this point of time. So I'm just highlighting this one, what exactly the survey results. So there was a how frequently do you apply a Monte Carlo analysis? In nearly every valuation as required by circumstances, infrequently. So the 53% says this one, whenever it is required by circumstances. So then what type of engagement do they seem to most appropriate? Majority of the things, it will be for the purpose of financial reporting, but the valuation of a complex financial instruments where the or securities and early stage valuation, early stage company or asset analysis. That is the majority of the survey shows that it is applicable in those circumstances. We can use the Monte Carlo simulations. So there is other things also they just mentioned, and also it is a litigations. Majority of them are using. There is another question. Why do you want to use a Monte Carlo analysis in your business valuation engagements? So majority of them says this one, I don't understand the method well enough to be comfortable using it. Yes, that is a true. So now based on the brief introduction, so I'm just going to take it as the basics of the Monte Carlo simulation, how we are going to do a Monte Carlo simulation for the stock price predictions or where we can use it. I'll just share my presentation. Will you able to see, Silpa, the presentation?
Yes, we
Yes,
are able to see.
we can see.
Yeah. So after stating this one, the majority of the valuations, it will be on the complex financial instruments.
Can you please put it on presentation mode, please?
Okay. Will you able to see?
Yeah, thank you.
Yeah, thanks. Okay. So based on that one, we are planning to cover as a two parts. One is the basics and second thing is in advanced. So let's see this one, how we can take it further. And also the fundamentally, if it is right to understand this concept, then it will be easy to apply in a practically. So this first slide is so important. So if you see the dots, so dots is represents, for example, it is the stock prices. So it will be the Monte Carlo simulation what does. So it will be at the various paths. It is if you observe the dots in this presentation, first slide. So it will be at the various paths. It will take it in the future, and the average results of this, what of the simulating results will be considered as the output for the any of the valuations. So let's understand based on this one the other concepts. So let me what I am going to cover today session is just like introduction and what is the softwares we are going to use it for the Monte Carlo simulation to ease our process, when to use the Monte Carlo, and what is the examples we can use it in the valuations. I have covered a few, but most of them might have a different opinions or in the different valuation point of view they can consider. And what is the stochastic process? The Monte Carlo simulation is nothing but it is a stochastic process. I will just cover the what is the concept and what is the Monte Carlo math. So GPM is the one of the predominantly uses in the Monte Carlo simulation, that is the geometric Brownian motion. And what is the process and what is the advantage and disadvantage? I'll just cover the basic case studies and what is the Monte Carlo final process. So this is what the agenda of today. Let me get into the introduction. So how many valuers are more worried when we are doing a maths? In the sense, in the option valuation, most of the times it will be a I can say a lot of maths is involved. I am so much worried about whenever I am doing option valuation. Hello. Hello.
Yes, Rajesh.
Yeah. Okay. So how many are more worried? Because I am so much of worried because whenever I am doing the option valuation or Monte Carlo simulation, I am little worried.
Well, most of the people, since we background from commerce,
Yeah.
I think most of the people are afraid of this maths.
Yes. Right. So don't worry. So whoever is applied first time, they might have applied maths also in the whenever we are doing option validation. We are the first time we are doing that one. Okay. So give me just 1 minute and just. So is there any specific apps for the usage of this Monte Carlo simulation? So there is a two. Predominantly uses of this Monte Carlo simulation using the software. One is the crystal ball and at risk, and another one is we can use in the Microsoft Excel also, but it is very difficult. But only for smaller simulations, for example 1,000 to 10,000 simulation, yes, we can do it. But if it is a larger 1 lakh simulation or 5 lakh simulations, then it is very difficult to do in the Excel. So let's move further. So when do you need the Monte Carlo simulation? So can anybody can just say this one in the practically if they have applied. So when they have used or any specific circumstances,
when
just
there
throw a
are
light on this one.
a number of possible outcomes, we can use this. Like if valuation is, in future is referred to EBITDA, a particular EBITDA, an outcome of a like market price, you have a number of possibilities, right? So for predicting that, you can use this.
Yeah, agree. So predicting the future, maybe any circumstances. So I'll just put it across some of the examples, so then we can look into this one. Okay, startup companies newly won, yes. Sales projections, yes. Okay, to summarize this one, when the situation requires forecasting the future. So when these circumstances it will come. So for I just given a few of the examples. Okay, so when the situation requires forecasting the future and risk and uncertainty involved in the valuation. So when this risk and uncertainties it will be involved. Suppose for example, the sales is a predominantly much higher than the historical growth rates. So then, and your margins also maybe the substantially higher than the historical margins. So then whenever we are doing a DCF valuation or any particular circumstances, so the uncertainty is involved in case of the sales or maybe a margins. So then in that scenarios, we can use it. So maybe uncertainties, it will be a discrete uncertainty or maybe a continuous uncertainty. So discrete uncertainty, I can give you the one example where suppose in case of a pharmaceutical industry, the FDA approval. So if FDA approval is not received, so then it will be a substantial impact in terms of the operations and also in the revenues. So there will be a discrete yes or no. So in case of the continuous, there may be a chances of small changes, like I said, revenue growth rates or margin growth rates, maybe a 5% to 20% range. It will be there in the historically. So then there will be a chances of uncertainties involved. So whenever the uncertainty is involved or whenever they're forecasting the future, so at that point of time, we can use the Monte Carlo simulation to get the multiple outcomes with the average results. So that will be considering as a part of the output. So this is a great tool to remove the uncertainties. So based on this background, let's understand one by one. So where we can use the Monte Carlo simulation in valuation. I've just given a few examples. So based on the little experience what I have in the usage of this MC in Monte Carlo. So I am just highlighted 7 cases. Option valuation. So everybody knows, but if it is a European call option, then will be a chances of using a MC is very, very less. But however, we can use for the option valuation in the Monte Carlo simulation. Another one is a predominantly uses of this Monte Carlo simulation in specifically in earnout. The earnout is nothing but it's a contingent consideration. In the business acquisitions, so there will be a chances of the valuation gap between the buyer and seller to cover it up. So they will use this mechanism to bridge the valuation gap. So if you see the earnouts, it will be based on the futuristic EBITDA or maybe a futuristic revenue or maybe a futuristic of EBIT. So based on these parameters, so they will decide how to calculate the earnouts. So I have just covered a sample, whatever the practically I have considered. I will discuss further while I am doing the earnout calculation using the Monte Carlo simulation. So there is another circumstances whenever the ESOPs are maybe a relative total shareholders return when they're considering. So based on the futuristic market growth rate or maybe a share price growth rate or maybe some performance condition, at that point of time, we don't know what is the future it will be. So we have to predict the future and we have to arrive the some of the vesting conditions and we have to allot the ESOPs or maybe what is the shareholder returns has to be passed on to a senior management. So in that scenario, it will cover. And DCF, yes, we can use it, but let's see this one. So in the convertible instruments, especially convertible instruments, sometimes it will be a fixed to fixed ratio and fixed to variable ratio. The fixed to variable ratio, sometimes it will be based on the future EBITDA. So they might have given the conversion ratios based on the futuristic EBITDA. So it will, we have to use the Monte Carlo simulation. And especially in the litigations, yes, we have to do a multiple outcomes and we have to arrive the what is the lost profits, for example. So these are the examples which predominantly can be used. And especially the only method we can use it for the earnout calculation, it will be a Monte Carlo simulation. So everybody is in same page? Hello?
Yes, Rajesh.
Yes, sir. Yeah.
So this is the, we have just highlighted the few of the examples where we can use it just to get a hang on the what is the Monte Carlo simulation where we can use it. So if you see the first slide, there will be a forecasting the future. So yes, majority of the time we in the examples what you have given, it is for the forecasting the future. Based on that outcome, either we will discount it at the present value or maybe a future value. So we are going to arrive the valuation. So what is that normally what we are doing in general, deterministic, only a single point estimate what we are doing right now. But if you use the Monte Carlo simulation, there will be a multiple ranges or multiple outcomes we are generating. And based on that analysis, we are giving a range of the output or maybe a valuation. We are just estimating. So this is the basic introduction of the when to use and examples of usage of Monte Carlo simulation in valuations. So with this concept, with this introduction, I'm just introducing the stochastic process for the deterministic process. Hello? Hello?
Yes, we are there.
Yeah, okay. So what is the stochastic process? Actually, and deterministic process. See, normally in our DCF valuation, for example, this is predicts a one single outcome in the deterministic nature. But whereas a stochastic or a random process or non-deterministic process, we are introducing the concept of predicts a set of possible outcomes. It may be a random process. So simple, for example, what if analysis. If you are using, sometimes you will be using in the deterministic stage also. It is a what if analysis we are doing. Is a best case, worst case, most likely scenarios. But you would be restricting to three types of outcomes only in a deterministic nature. Maybe a single outcome also we are doing. So in the stochastic process, it is not like that. You will be predicting the multiple outcomes. So multiple what if analysis. How we are going to do it, we will cover it up in the next slides. So what is the stochastic process? So I will just give you the little background of the before starting of the Monte Carlo math. So what is the stochastic process? Any variable whose value change over time in an uncertain way, said to follow a stochastic process, is nothing but an equation describing the probability behavior of a stochastic variable. What do you mean by stochastic variable? Stochastic variable may be based on the above examples, either stock price, maybe a revenue or EBITDA. So that is what the variable, what is that, whose future value is very uncertain. So in majority of the deals or majority of the option valuations, all these kind of a net predominantly in the valuations, it will cover either stock price or revenue or EBITDA. That is what the variable. So whose future value is very uncertain. So then in that scenario, so how we are going to determine the future price, it is based on the stochastic process. That is a random process. So let's understand what is the classification of stochastic process. It is a continuous time domain or continuous state space, or discrete time domain or discrete state space. So continuous time domain means changes in the variable can take place any point of time. Let's understand the stock prices changes during the trading hours. It will change in a non-integer also. It may be in the points. At every minute it will change the stock prices. So that is the continuous time domain changes. This concept is very important to determine what is the distributions. So that is the reason we are just bringing the basic concept. So, and also there is one more concept is the continuous state space or variable. So variable, what we have defined is the stock price or revenue EBITDA. So underlying variable can take any value within the certain range, stock prices, for example. So it will be within the range. So similarly, discrete. So it will be, if we are looking end of the day stock prices, then it will be a discrete time domain. So or maybe end of the day, maybe of mutual funds. So then in that scenario, it is a discrete time domain. And there is a one more concept, discrete state space. Only certain discrete value are possible. Suppose, for example, number of defaults in case of the loan or number of claims from the insurance. So these are all the discrete state space. So just a basic understanding of the stochastic process, how it works. So then it is a continuous variable and continuous stochastic process follow for the stock prices. So let's understand the Markov property. So this is very important concept in terms of the stock price predictions or any revenue or EBITDA predictions. The Markov property, what it says, only current value is relevant irrespective of the past, whatever it is happened. So normally what will happen when you are predicting the future, the past history of variable, it is not at all relevant. It is only at the state immediately the previous day stock price is relevant for the purpose of the stock price predictions. So it implies that probability distribution of price at any particular future time is not dependent on the particular path followed by the price in the past. So it is not relevant. But there is one more concept called consistent weak from market efficiency. Present price of stock imports all the information contained in the record past prices. Hence, we are going to use only a current state of the stock prices for the purpose of the future determination. So similarly, in the case of the revenue also is the current state or maybe the management projections, we can take it and we can further predict what is the future it should be. So with this small background, so I will just introducing one more concept is a Brownian motion and geometric Brownian motion. So any price, continuous time, continuous state space is an example of Brownian motion. Stock prices changes during the period, minute interval of time, values are not an integer. It means that whenever the continuous time, so I have just defined what is the continuous time domain change and continuous state space are variable. So if these two changes continuously, then it will follow a Brownian motion. What do you mean by Brownian motion? Stock prices are independent increments. So it means that yesterday price only is relevant, not a day before yesterday price is relevant, and yesterday price and today's price. There is a one independent increment, and today's price and next day price is independent increments. It may not be a overlap the increments. So how we are going to do it this one? So we will cover up in the case study and follows a normal distribution. It will be a mean zero and standard deviation and continuous sample path. So it will be a continuous process, and this is sample path, it will be a continuous. However, the stock price cannot be a negative. So that's why we should use the geometric Brownian motion, log normally distributed, which has been brought into a GBM for stock price predictions. For stock price, we typically assume a normal returns and log normal prices. So with this understanding, let's understand what is the math involved in the Monte Carlo simulation using a geometric Brownian motion. This is a very important concept. Please try to understand the concept in a simple manner. I just made it simple, but I am also so worried in terms of the math whenever is involving. Let's understand in a detailed manner. So this is the geometric Brownian motion. I have just assumed here it is not a dividend paying stock company. So if it is a dividend paying stock company, then the R is a risk-free rate or maybe a risk-adjusted rate minus the dividend. Only that small change it will be there if it is a dividend paying stock company. So let's understand the current state of the price. So how we are going to determine the current state of the price? Hello?
Yes, Rajesh.
Yeah, are we in same page?
Yes, sir.
Understand?
Yes.
Yeah. So let's understand, this is the the current state. I'm only just drawing the pen. Okay. So this is the future price ST plus 1. Okay. So this is the start with the today's stock price. So what I discussed based on the Markov property, what is the stock with today's stock price is nothing but yesterday's price. Exponential, and this first term, call it as a drift, determine the expected return, and means it will be a constant directional movement. So it means that the expected return with adjusting of the volatility. So basically the stock price of the current stock price, the future price is based on the yesterday price plus expected return, adjusting with the volatility or a variance with the time period, and we are introducing the concept of the randomness. So this is the randomness. It's the second equation is a shock. It is a stochastic component. It's a random variable. It means that we are this is the single path. So the prediction, what it is a single path. If we are doing a single path, then we are introducing the one is the expected return, adjusting with the variance, and the second is the random process what we are introducing. It means that it will be for a single path, there will be a multiple outcome, single outcome. Like that, if you do a multiple outcomes, then it will be what is the average of that results? It will be the what is your future price. So I will just explain in clearly in the case studies. So then you can able to understand this one. So what is the meaning of the S is the current value, and what is the time period and the exponential function, or is the risk-free rate and volatility and random number. So first, so I am just repeating once again. So this is the first term is the drift, deterministic expected. Here also we are bringing the concept of deterministic. We are bringing the deterministic. Second component is the shock. So it is the random variable we are introducing, and we are adjusting the stock prices. So let's understand clearly with the examples now. Normally, stock prices are believed to follow geometric Brownian motion, which is a Markov process, which means certain state follows a random walk and future values dependent on the current value. It is nothing but a Markov properties. Are you able to understand?
Yes.
So
Yes, yeah, got it. Yeah.
So let's understand in detail with the case studies. So then you can correlate with this one. So there is a
So just one question. In the previous slide, when you say that random number, right?
Yeah.
How do you select that random number?
So there will be a pseudo numbers is there, and Latin hypercube numbers are there. So there is a rank zero, rank open.
Your voice is going a little distorted. Is everybody also hearing that, or is it only for me?
That's why I have switched off my video also.
Okay, yeah.
Are you able to hear, sir?
But
There's
still
background noise, sir.
as you speak, there is a little bit of distortion in the sound. Maybe
Static, so there could be some instrument that is creating the static.
yeah. Maybe some of the program running simultaneously. I don't know.
I've switched off all the.
Yeah.
So yeah, this I'll show you in the Excel sheet, sir.
Okay. Yeah.
It has been, I have splitted all the components.
There's a lot of disturbance. Voice is tracking. Voice is tracking again.
No, it was not there. So maybe something changed now. Check that, Rajesh.
Yeah, it's not a background noise, but it's a distortion that comes up the moment you start speaking. Yeah. Okay, go ahead, sir.
Okay, so I'll just cover it up in these case studies. So in detail, then we can come back on this.
Yeah, again, it is coming, sir. Maybe No.
It's okay.
Otherwise, log out and log in again.
No, just we stop presenting and then start presenting again or something.
Maybe if you're using the headphones, if headphones are shaking.
Yeah.
I'll just remove my headphones.
Yeah.
It's okay, sir?
Yeah, now it's better. Yeah.
Okay. So in layman terms, the GBM forecast.
Oh, no, it has started coming again. It is coming again, sir. Yeah. It's like a static noise that comes the moment you speak. And it stays as long as you speak. Yeah.
Log out, login only might solve the problem.
Yeah,
Maybe, yeah.
Please log out and log in.
Yeah.
Hello.
Yes.
Hello.
Yeah, it is persisting, sir.
Yeah, there is some background noise also which comes and the voice also is distorted.
I just close. I'm in close room.
You can leave the session and come back.
Yeah.
I take this opportunity to make few announcements that, we are planning to issue a newsletter and we request articles for this newsletter, as well as we want the volunteers who will, share the responsibility of bringing out the newsletter. Please approach me directly. Together, we all can make it.
Hello.
Yeah,
Hello.
clear now.
Yeah, it is clear now, sir. Yeah, it is clear now. Yeah, correct. Yeah.
Yes. Okay. Now it's clear, sir?
Yeah, absolutely. Absolutely clear.
Okay, thanks. Okay. So in geometric Brownian motion, in just layman terms, is a constant drift. It means a expected return in a constant directional movement in the stock prices captured by the volatility input and shock which is accounted by the random number. So let's.
Sorry, sir, your PPT is not visible. Sorry.
Your PPT is still yet to come up. We are still seeing a screen where a checkbox on Monte Carlo simulation has been selected, but the PPT is not as yet visible.
No, sir.
Not yet.
No. Your screen has frozen. Yeah, okay. Yeah. Now it is, yeah. Now it's fine. Yeah.
It's a concepts is the heading.
Yeah, correct. We can see the concept slide. Yeah.
Yes, we can see.
Yeah.
Okay. In the layman terms, the GPM forecasts a constant drift. It means that it is the expected return is a constant in the stock price captured by the volatility input and shock which is accounted by the random number. In the Excel sheet, I have splitted both the what is the drift and what is the shock component. So I'll just explain you in the Excel sheet. And there is a two concepts: is a risk neutral drift and there is a risk adjusted drift. So sometimes in the valuations we are using the risk free rate and sometimes we are using the risk adjusted drift. So especially in the contingent consideration, we are going to use the risk adjusted drift. I'll just give you the example in the Excel sheet. So in case of the risk neutral drift, we are using the risk free rate, especially in the ESOPs and total shareholding returns in calculations. So with this small background, and small Monte Carlo math. I am just taking the case studies. So let's, I'll share the Excel sheet. So can you please confirm this one Excel sheet is visible?
Yeah, visible.
Yes,
Yeah.
yes.
Yeah. So let's understand the expected drift is annually is a 10% and volatility is a 40%. I'm not covering up this one. So everybody knows this one, how it has to be arrived the volatility, and we have covered in the past also, so many seminars. So I'm just expecting this one, known everybody. The expected volatility is a 40%. And what is the daily drift and daily volatility? So this is the simple calculation what we have carried out to arrive the volatility and 252 trading days. So we are assuming this one. And what is the expected daily drift? So let's understand how we have generated a random number. The simple formula we have used, normalness inverse rand 00 is the probability. And what is the log return? This is the two ways we can calculate predict the stock price. Now it is 100 is the stock price. This is the number of days. I have just assumed this one. It is 10 days. I want to predict the future stock prices. So it is the stock price is 100, and I have generated a random number. And what is my expected log return? So based on the GPM formula. So what is the expected price of the future on the particular day, on the next day? So if it comes to a second day, the previous price is relevant for me to calculate the future price. If I'll go to third day, it will be a second day price is the relevant for me. So similarly, if I'll go to a 10th day, then the previous ninth day price is relevant to arrive the futuristic price. So this is the single part what we have calculated for the 10 days stock price predictions. So based on the GBM formula.
Sir, 1 minute, if I can stop you. See this log return daily. In day one, it is 0.2%. In day two, it is minus 1.95%, right?
Yes, based on
how has that changed? If you could just explain. And likewise for the random number also.
So based on the daily volatility.
Okay.
So it is based on your random number also. So if I'll press a F9, for example, so then it will change.
Okay.
So it means that we'll come to here. So your expected return is a constant here. If you see so I have split it in the option 2 also. So just to understand, the first component is a deterministic component. It is a constant. So your return, though it is a returns are affecting because of the shock. So this is the uncertainty component where the second equation. So the second equation, which is basically nothing but is a random number with the volatility. So this is the constant. If you see the first component, so your expected return is a constant, but we are bringing the concept of the uncertainty associated with the stock price using the volatility and random numbers.
Okay.
So this is the option 1, and option 2 is the calculation part. If I am predicting for the next second part, suppose it's the same data I am using with the multiple random numbers, is the third part or fourth part or fifth part. So I have just calculated for a fifth part, and we have just arrived at what is the average of all the paths. So this is what your average price on the particular day, the futuristic expected price based on the random. If I want to calculate for 10 days, so then average it will be 101.08.
Okay.
So then so what we are trying to say here, 1 day prediction, it will be like this. The 5-day prediction, if I am done 5 simulations.
Okay.
So the 5 simulations, it shows like this. If I am pressing a F9, so then obviously the random numbers is changing, and correspondingly the stock price predictions, it will change. So what we are trying to say this one, using a Monte Carlo simulation, multiple outcomes based on the number of simulations what you are going to run in the software. So based on that outcome, we are taking out the average. See, normally what we will do in the deterministic single outcome, there will be that is also is a distribution only. But in Monte Carlo simulation, what we are trying to do, it will be multiple outcomes we are going to generate it using the random number and number of simulation, maybe a 1 lakh or maybe a 5 lakhs or maybe a 10,000. That also I will just cover how many number of simulation has to be run to get a precise calculations in later slides. So that's what we are going to do it in the Monte Carlo simulation. Your expected return, it will be a constant, but we are bringing the concept of stochastic process. That's a random process, which we are expecting the price at on the particular day or maybe a particular year, depends upon the nature of the valuation.
The price predicted is the same whether it's option 1 or 2. It's exactly same.
It should be same. I am just calculated option 1 for 2 straight away if you want to calculate. No, I want to understand the concept of GBM. What is the drift and what is the equation? I just split it, that's it. Both are same only.
Okay, thanks.
So, Rajesh sir, the paths which you chose, the 5 different paths, those, I'm so sorry, but it's option 1 or option 2?
This is option 1.
So these 5 paths are for option 1, you're saying?
Yeah, option 1. Option 2, I have just to get a comfort for me to whether does it really make sense from the point of view of the equation. I have just reconciled with this one to explain these 2 concepts.
Okay. Okay.
So I have just calculated. If you want, I can calculate. That is okay. Just to understand whether whether does it really make sense? Is a deterministic nature or not? Is a constant directional movement.
Okay, thank you.
But this is one of the drawback for the GBM, because this may not be a constant, but we have to live in reality. That is a practical way we have to be. Okay. So just basic GBM. This is to predict the stock prices and multiple paths. So with this small understanding, let's move to a GBM 2 is another example I have just taken. So I have same formula only. I have just, if you will see this one, the same formula only, but in I have just consolidated the formula here. Here it is a random variable. Okay. So if I'll see here, so it is a previous price only. So I have just calculated for the 2 years. Suppose in this example, what I am trying to say this one, stock price at the end, based on the stock price and growth in the stock prices, the adult price has been determined by the company, which based on that one, the vesting, it will start based on the stock price of at the end. Maybe sometimes it's the stock price at the end. Maybe sometimes it will be based on the 20 days average prices also they may take, depends upon the terms of the agreement, or maybe sub-agreement or something is like that. If I have run one simulation, so if I do simultaneously, so if I press a F9, F9 is a function to change the, F9. So if I change the F9, then, sir, will you be able to see my screen?
Yes, we are.
So I am just generating a one stock price at the end. So it will change every time when I am pressing a F9. So this is also is the biggest drawback. Whenever we are doing a valuation, we have to make sure this one pays specially your random numbers. Otherwise, every time whenever you open the Excel sheet or whenever you want to prepare a report, then it will be a problem for you.
Sir, one question. In the lookup table, the third column to the right, percentage which vests you are writing there, right? How can the percentage exceed 100% if I've understood that percentage, that number correctly? what does percentage which vests actually?
No, if it is a 121, then it will be 100%. If it is a adult places crosses, then it will be a 200%.
Okay, yeah. Yeah, so technically, is my understanding correct that the percentage which vests can never exceed 100%, right?
200%, sir.
What does this really imply? So percentage which vests means if options have been given out to, let's say there's an employee base of 100 people, right? How many people will come to a situation where they actually, the options would vest with them, right?
Yes. Yes. If suppose you see, for example, if stock price at the end, so it will be 121 to 126 in that range. So it will be 100%. So if I change to 22, then it will be 0%. So there will not be any vest.
Okay. Okay. So this cell F10 that you're doing eventually will never assume a value which is more than 1 or 100%. Is that right?
200%.
200%. What do you explain? How do you explain 200%? Which means if 100 options have been given, 200 will get vested.
No. So 200% of the shares. If suppose is a 10 shares is there, so then it will be they may get the 200%.
Can you actually explain the parameters here before we
Yeah,
talk about
I could
what is
not.
stock price?
Okay. No, see, this is the adult price. So I have just given a growth of a 5%.
Right.
If it is exceed the 15%, so if you suppose is the 10 shares is there, so 200% they will get.
What do you mean 200%? I could not understand. Help us understand.
No, 20 shares they will get.
These are the terms of the agreement, Superadu.
Terms of the agreement, if they will get a 200% of the shares. Suppose is the 10 shares is agreed for the 100%.
Okay.
So then they may get the 20 shares, 20 options.
No, but only 10 have been agreed. How will they vest 20 is the question. See, typically in a stock option, what happens?
No, it depends upon the stock price at the end.
Okay.
It is not, it depends upon the agreement. So agreement also, they will define these parameters.
Okay. Okay.
So if it is adult price is crosses of 132, then they will get a 200% also.
Okay,
Superadu, treat this as a warrant. Don't think as a ESOP or a single share, 1:1. A warrant can convert into any number of shares. And the word PCT is confusing everyone here. It's not percentage of conversion. It's just the ratio. So, but the hurdle rate of 132, they are giving a ratio that 2 times you will have the warrants, whatever number of warrants you have, 2 times of that will be the conversion.
Okay.
So it depends upon the transaction, how it has been.
Maybe my understanding of that parameter itself is not correct. I need to do a little more background reading, perhaps. Yeah. Thanks for
this. This is the adult price. So what we are looking here, sometimes the company they will define this is the adult price based on the growth parameters. So based on that one, the vesting it will start. So I just given an example. So how we can use the Monte Carlo match to arrive the stock price at the end. And this is the one simulation only. We have to do a multiple simulation and arrive the average of that particular price. Based on that one, we have to determine this complete exercise. Okay. So how we are going to do it, that maybe we can use the either GBM, either crystal ball, or maybe at risk we can use, and I'll just show you how the report it will be. So once if you taken a last example, I can just cover it up that one. So this is the single simulation, but
I have to understand a little more. You're telling at the beginning of the period, the stock price is at 100. Correct. Yes. That is what is mentioned in C3. Cell number C3 says the C3 says the stock price is 100. And stock price has actually now in this case it has increased to 183.71. So there is an increase by 83.71%.
No, see that is the deterministic nature. So what we are trying to say this one is a feature is my uncertain. So how we are bringing this one? So we are just run one simulation to arrive the stock price at the end.
Okay, so right now what we are trying to tell is, see, when the stock price that was at 100, if it actually reaches at 183.71, then whoever has opted for it will be entitled to twice the number of stocks. Is that what is the
No,
understanding?
based on the hurdle price. So if it
Yeah,
is
hurdle
based
price
on-
is actually increased. It shows that the growth is 15%. The
Yeah,
very fact that the stock price at the end is at 183.71 is the
Yes.
return
Yes,
is
yes.
83.71. So therefore
Correct.
so that
In
is how
your
we have
vesting,
to
it will
read
be
it.
200%. But however, you run only one outcome only here. So you cannot say this one based on the one outcome. Just
you have to do this multiple times, so maybe
no,
lakhs of times.
you have to run the simulations. If it is a 1 lakh simulation, it may come up with the 130, for example. So in that case, 130, if it is there, then it will be 100% only. It will come.
Yeah.
If you do a 1 lakh simulations, this is the one path I have done it. So if you do a 1 lakh simulation, the stock price will be 130. In that case, it will be 150%. It will be the vesting percentage. So I've just given a what. So there's a basic one simulation I have done it. If you run a multiple simulations, then it may touch the stock price at the end 130. So in that scenario, it will be only 150%. So we don't know where exactly it will fall your stock prices at the end in the 2 years down the line. So how we are going to remove this uncertainty? So based on this factor, we are calculating a multiple outcomes and arriving the average price. Sorry, average stock price at the end.
Rajesh sir, is there any logic or science behind number of simulations we should do? So for example,
yeah, that I will cover it.
Okay.
I will cover this. There is a one article which has been published by the Valuation Research Committee, BRC something. I'll share that as well. So based on the precision level, so to get a precision of 0.001. So then with the standard deviation, with the square root of something it is there, that I'll chi-square test or something it is there. I'll share that article and also I'll try to cover that one. Because this is the very, very problematic for everybody. So I will run the 10,000 simulation and I'll just keep quiet. So that cannot be possible. So we need to look from a different perspective also.
Yeah, it's also scope for misuse, right? People can easily start working the other way around and choose this number.
So other way around also, yeah.
Yeah.
No, I understood. So that is the reason we need to look from a different perspective, and from a legal point of view also we have to think whether this is acceptable for a 10,000 simulation or 1 lakh simulation.
It's a potential lever for misuse.
Yeah, definitely.
Rajesh, how do we do 1 lakh simulations? So you have this Excel sheet. Do you have to run this 1 lakh times, or is there a shorter methodology for that?
No, if you use the Oracle crystal ball, it won't take much time. So if you do it in Excel, it may take a longer time. It may take longer time, and also your Excel sheets it will get a hang.
Okay, so what is the particular? Can you name that software, please?
That is a shot in the presentation. Oracle something in @risk or something like that.
Oracle crystal ball and at risk.
At risk, but little costly. That one maybe $1,000 to $1,500 it will be there per year. But for one engagement we cannot use it. But 15 days free trial they are giving crystal ball, so you can download. And once my presentation is over, then I will just share that one in the chat box. So 15 days free trial is there, so we can download that one and we can use for the purpose of any assignments.
Sir, what is the Sir, just one question. What is the relevance of a term which is mentioned in column C, row 4?
The term. Term is nothing but for the 2 years price to determine.
So we are determining the the price at the end of the 2 years.
Yeah, 252 into 2.
Okay. Number of trading days into 2 years trading days is 504. Okay. Okay.
But how can it be 2 years? Because you are actually taking the opening and closing, because it should be, or you're
No, I
you're
have just
actually knocking
given.
off all
No,
the
no.
holidays and you're only taking the trading days, is it?
Yeah.
Yeah.
So I'm just estimating based on the only trading days. Okay. So there is one more example what I have just shared with you. This is just simple option valuation. Again, is the same formula. Here I've just changed. This one is a normal distribution. I just mentioned one. So I'm just comparing with the Black-Scholes model and with the Monte Carlo simulation, how the differences it will be. So in this case, is the current stock price is 20 and exercise price is 30 and 35% is the volatility. The risk-free rate is a 2%. It is a compounded. This is a very relevant for the ESOP valuation also. I will tell you based on my experience. Majority of the, normally what we will do, we will take the risk-free rate and will not compound this one. So the Big Fours, whenever I am doing with them, the valuations, they're insisting to do this risk-free rate, log normal compounded rate has to be used. So this is very relevant for many of the practitioners. So we normally I don't know how the practice across all the persons, but I am using the risk-free rate straight away. So then this is one of the observation from the across the Big Fours. So they are insisting to do the risk-free rate is a compounding one, because the risk-free rate is not a constant. So it should be a compounded one. We have to use it. So, okay. So then here what we are trying to achieve. So though it is a deep out of the money, exercise price is 30 and stock price is 20, but I am future price I need to determine at the term of a 5 simple European option. This is 35.59. So the option cash flow at the termination, it is a 5.59, and what is the present value of the value of the option. If 1 lakh simulation, if I run in the crystal ball, so that will be a 4.12. So whereas as a Black-Scholes, it shows that 4.11. So there is a difference of $1. There is a percentage of Black-Scholes value is 20.25%. Let's see the Black-Scholes model also. So this is what we have calculated, 4.11. In simple Black-Scholes model, what it does, and Monte Carlo what it does. So if it is a normal distribution, the Black-Scholes model, what it takes, everything together it takes and it arrives the stock price. In the Monte Carlo simulation, if it is a normal distribution, it will take 1 point in one particular iteration, and second is another iteration, third is another iteration. Like that, it will calculate each outcome and arrive the price. So this is what the basic difference between the Black-Scholes and the Monte Carlo simulation. So otherwise, this is a very straight example.
So if
could
it
you
is a
please
normal
repeat that?
distribution,
Repeat that the difference between Black-Scholes
The
model and
Black-Scholes,
Monte Carlo.
okay. So see, the Black-Scholes, what it takes in 1 minute. In Black-Scholes, what it takes all together. So it will not be what you can say, not a single outcome. In this case, what is happening? It is a single outcome it is taking, the particular price. But in case of the Black-Scholes, it will be all together it will take in the Black-Scholes model. It is based on the single outcome, and we are arriving the average prices of this in the Monte Carlo. But whereas in the Black-Scholes, it is not like that. You are giving just some straight inputs, and you are just arriving the Black-Scholes model. It means that together it takes It is not based on the single outcome. In the earlier example, what I have told, it is a 130. If 1 lakh simulation, if it takes the average of all the 1 lakh outcomes. But whereas in the Black-Scholes, it takes only a single outcome. It is a deterministic kind of a deterministic nature, but it follows the same GBM methodology only.
So may I say something, sir?
Yeah.
So essentially what happens is in a normal distribution, the average is tendencies towards the mean and the standard deviation. That's the starting point. I think you have used the mean and standard deviation is 1 and 0. So in a Black-Scholes, we are using straight on that the mean and standard deviation is there, and therefore you get a value. So in a Monte Carlo, you are taking the random numbers, and the tendency towards the mean is something. So you do more and more simulation, number of simulations in Monte Carlo, the more and more the value will reach towards the Black-Scholes value. So if you increase it to 10 lakh, 1 crore number, the tendency is towards the mean. So I think that's the way you'll see the difference of 0.01 because you have done nearly 1 lakh. If you would have done 100, it would have been much higher difference.
Correct. To me, it will be a precisely it will not come if you run a less trials. Agree, sir.
Help in application the revenue projections, financial projections, and everything apart from the stock price. Is there a plan to simulate that?
Yeah. So yeah, I'm just planning to cover in the second session. I'll just cover it up maybe in the sometime in the advanced model.
Sure.
So this is the basically to get a hang of this one.
Thank you.
So I will cover the now contingent consideration. So in that one it will cover. Contingent consideration I will cover. Slightly I will just discuss. And maybe in the advanced level, maybe we can take it up based on your inputs. We can take it up further. So specifically in the majority of the values will be using a DCF. So I am just planning to do a DCF with the simulated valuation with a normal DCF valuation. So how the results it will be differ. That is one thing. And second thing is the contingent consideration. Predominantly we have to use that Monte Carlo simulation in case of the notes. So I'm just planning to cover that one in the advanced level.
Rajesh, sir, I have a question. So basically, Monte Carlo and if we don't have the strike price, like in the kind of a CCPS or OCPS, okay, then in that case, Black-Scholes would not be feasible, right? But then only we have only one option to use Monte Carlo. Is it correct?
Yes, but we can in the Black-Scholes model also exercise price is 0, so we can, but it will not work with decent experience. So I have just made it at a 0.0001 for the exercise price. Yes, you are right. So you can use the Monte Carlo simulation and probable what is the exercise price can be decided based on the facts of the case. If we can arrive the probable exercise price also using the Monte Carlo simulation.
Okay. Okay.
Okay, so there is a one more example. It's a similar to the previous one, but I have just calculated each number of iterations around 5,000 iterations. So same thing, and we have arrived the option valuation of 5,000 iterations. So this is a very straightforward. So both is the same current market price and strike price, and what is the risk-free rate is the 6% historical volatility. So then we have just calculated here also for 5,000. As you said, sir. So the percentage is slightly higher because of the lesser simulations. Hello. Hello. Yes.
Yes, Rajesh.
So this is what we have done it. So just to understand how it works. Then there is a one more. Here I have done I tried to done a 1 lakh simulation, but see what I have done it here. So similar inputs I have taken and simple data table. So if it is a simple one, we can use the data table and arrive the so if you want to do some small so we can use the data table also. Sometimes we have to select just so it will come automatically. So, but problem is this one. If we are doing a 1 lakh simulation, it takes a lot of time. So if you see here, 36 is the stock price. So it is a 30 is the exercise price. So what is the discount present value of the option? Automatically it will come. So we can use the even data table also to do this calculation. But problem is here it is that it will get hang in the Excel. Is it clear, sir? Hello?
Yes, we are getting there. It is complicated, but yeah.
No, this is complicated, but better to avoid the Excel because of the number of simulations it will be much larger. Better not to use in the Excel. So for a smaller engagements, yes, okay. If you decided that 10,000 simulation is okay, then we can take this kind of approach also. So I'll just share the other the live what I have carried out one of the engagement. This is for the purpose of contingent consideration and also purchase price allocation. I'll just give you the brief. Will you be able to see my screen?
We are seeing Excel.
Yeah, we're seeing it. Yeah.
No, not Excel. Yeah, 1 minute. The screen is visible.
Yeah. Right.
Visible? Yeah.
Yeah.
So this is the so this is the purchase price allocation, actually the assignment. Okay. But in this deal, totally is just $7 million. Out of that, 4.25 million is the upfront payment, and the remaining 2.75 is the contingent consideration.
Yeah.
So why they are bringing this kind of a deal structure? Because they're not sure about the future what going to be happen.
Yeah.
So the deal structures, how it will happen, it will be based on the revenue achievement, or maybe EBITDA achievement, or maybe EBIT achievement. Something is like that. So a couple of scenarios like this. Sometimes if it is a FDA approves, then yes or no distribution it will come. So if FDA approves, then probably revenue is going to substantially it is going to increase. So whenever the deal is happening, so then there is a buyer expectation will be higher and seller expectations will be higher. So then they want to bridge the gap between these two. So they're bringing this contingent consideration into picture. So how they're going to bring various models they will build. So for example, if it is a revenue, So revenue has to be achieved so much. EBITDA has to be achieved so much. It's like that. So in this scenario, I'll just tell you the revenue threshold what they've given, minimum recurring revenue. So there is a one more concept is there in some companies, you know, ARR, annual recurring revenue, it will be sometimes it will be fixed. So if you know all the past, yes, probability of annual recurring revenue, it will be some $3 million. In the deal also, if they say this one $3 million. So you know in the past, okay, in the 1 year down the line, 3 million I'm going to achieve based on these existing contracts. In that case, it will be very straight scenario-based model. Okay, take directly the what is the contingent consideration and present value, you decide and disclose it. But sometimes, so what might have happened in this case, it is an annual recurring revenue, may not be a deterministic, and future depends upon the future contracts. So in that scenario, where I could able to use only a Monte Carlo scenario, a simulation to get the what is the future revenue for my for the company to get this the earnout. So with this small background, so minimum recurring revenue is a 1 million. The maximum revenue they've defined as a 3.40. The previous revenue is a 2.20. So the earnout structure is like this. If you achieve minimum recurring revenue 0.50, the maximum revenue, so then it will be 0.25. If target revenue more than 3.4 million is achieved, then it will be a 0.75. So I am little, how this structure can build into a model, it is very difficult for me to put it across. So then what we have done, so we have just calculated the, so here there is a one more concept is a required metric risk premium.
Rajesh, one question. In earnout structure, if you can go to, yeah, how come maximum revenue is less than minimum revenue?
No, so these conditions is like this. If it is a minimum recurring revenue, if it is achieved 1.5, it is a cumulative. It is not a straight. If you achieve maximum revenue, you will get a 0.5 plus 0.25 plus if target revenue is achieved, then it will be 0.75 like that.
Okay, so there is extra above the minimum one, which means if it's the maximum revenue, he'll be entitled to total turnover of 0.75 million.
Yeah. No, it will be 1.5 million.
No, part of the earnout, basically.
Earnout, it will be 0.75. It is
0.75, yeah.
So it's like that.
And in case he attains the target revenue, which is more than 3.4 million, then he'll get the total 1.5 million, right?
Total 1.5.
Yeah.
So I am based on the uncertainty existing based on the revenue right now here.
Right.
So what is your uncertainty factor? It is a revenue.
Yeah, correct.
So if we achieve the revenue, so we define the what is the earnout structure, but revenue is the uncertainty here. So I need to determine what is my revenue.
Yes, got it.
So as I mentioned, there will be other methods also is there, scenario-based methods and probability weighted return method. So then we can put it across. So, okay, what is the probability of getting this minimum recurring revenue? Maybe 100%. So what is the maximum revenue? Maybe 50%. But that is very subjective. So I cannot define my valuation at all. So based on that factor, I can get the what is the my future value and what is then I can discount at the present value. So that is very what you can say very subjective. So I cannot put it into my valuation. This is the probability has been achieved going to achieve by the client.
Yeah, correct.
So I will give you based on this factor. So that is very difficult for me to give any of the valuation. So what we have done right now. What is my expected present value of revenue based on the factor? What is the future forecasted revenue? First, I arrive with the what is the management given number. This one based on the ARR factor.
How did you get the volatility?
Pardon, sir?
How did you calculate volatility of revenue?
No, yeah.
Can you explain each of these parameters? How did you come through?
Yeah, sure. So right now we have taken a volatility, a standard volatility, but there is a detailed the best practice of valuation is given by the ASA. So there will be a two to three methods is there, AMDA method and practitioner methods is there. So in the practitioner methods, so the leverage portion has been removed, and for the asset beta, they have arrived based using the equity. So for the discount rate, not only a volatility, so we will get a doubt on the discount rate, and also is a volatility. We have to arrive based on the revenue, or maybe a beta volatility or revenue volatility. There is a separate guidance note has been given by the Appraisal Foundation. I will share that one.
Sir, that would help, sir, because we
no,
know
that
the
is
input.
already shared the most of the time in our group, but we will just look into that one, sir.
Thank you.
I'll just share that Appraisal Foundation. Jai Jain, as I remember, Jai Jain is shared so many times that one in the group also. But that this is the very critical factor for the any of the practice, because we are tend to do with the normal CAPM discount rate. That is also is a proxy for the revenue, some revenue and EBITDA sometimes, but may not be is the right one. So right now I have used the in my calculation is the CAPM because there is no debt in this involved. So I have just used as a proxy for this in this case. But actually we have to use a deleverage the debt equity portion without a tax impact. So there is a detailed discussion has been given in that note. Specifically is the practitioner methods. So that's what we are using that. I'll share that details. Okay. This is the for the, okay, I'll just tell you what is the calculation period is 1 and payment period is 30 days. So I have to consider the 30 days afterwards, and one simulation I have run, and what is the risk-free rate is a 2.1 in the dollar terms, and the counterparty credit risk I will explain a little later, and the metric what is for the revenue. What I have done is I have just used the CAPM only. Simple CAPM I have just used.
So ये metric specific क्या है ये? Metric
specific nothing, but in this case is the revenue is the metric specific risk premium. So either maybe a EBITDA discount rate or maybe a revenue discount rate, whatever it is that. So this in this case is in a note structure. It is a metric is the revenue. So what is the revenue discount rate?
Okay, got it.
So volatility for the period of 1 year, we have considered 56.70 for the industry, and forecast expected revenue is what we have considered based on the management. So and revenue discount rate we have considered. And
the volatility is stock की होती है या उस market की, share market की होती है?
Market this one. So as I explained, these two is the important for the purpose of the depends upon either revenue or maybe a EBITDA. So the volatility and discount rate has to be adjusted based on some parameters. I'll share the guide. I'll explain you a little later. Okay. So then, what is my expected present value of the revenue, and what is the random number? What for particular one simulation that we have arrived, and we have just brought the earlier concept what we have discussed, what is the to determine what is the feature at the single period. So that is what the geometric Brownian motion factor. So based on this one, risk neutral random revenue we have generated. If any time if I'm changing the random number, the uncertainty portion, so it will change. You can observe here. So it will change the earnout structure. And what is the future payment? So maximum earnout, it will be 1.5 if you achieve more than 3.4 million. It's a cumulative, as we discussed.
So that means that
based on that one,
sorry. Simultaneously, we can project for future 5 years by changing the time period. Suppose if I have today's revenue for 5 years, 1, 2, 3, 4, 5, I give a T is equal to, sorry.
No, sir, it will take too much of time, sir. You have to press F9, and you have to just note it down.
Okay, sir.
But we can build this formula and we can arrive this number. So I have not done it. I am little lazy now. So I have not done it in that detail. So if we use this same formula, we can put it across in Excel by doing a one simulation, two simulation, as I explained in the earlier 1, 2 iterations, 2, 3, 4, 5, 6. So you will bring this formula into this one and arrive the what is the expected revenue, and average of that revenue we will take it and we will consider.
Sorry for the trouble. Sorry. Okay.
No, you're right, sir. You're right. But problem is that one we have to do a. When I started this exercise, so I was not thought about whether we can do. We'll use the crystal ball and just close it. So that is the reason I am not built in that manner. So I can build it even using this formula and arrive what is the projected revenue of particular this one. I have to make a pay special and arrive the earnout payment for each of the scenarios, and then we can bring the present value. So now we will bring it to earnout. Say right now 1.5 is that one. So I have to discount at the what is the present value of earnout. So there is a CCR, there is a one more element, this is also is important in the contingent considerations, is a counterparty credit risk. So if suppose there is a buyer is having an escrow arrangement with the seller, suppose 0.5 only, why you are taking 2.75. So there is a one more in 2023 there is a structure of 1.25 something it is there. So maximum. So both put together 1.5 plus 1.25 together is the 2.75 million is the contingent consideration actually. Okay. So the counterparty credit risk, if it is a escrow arrangement is there, you park the funds into a separate bank account, you can withdraw at any point of time once if you achieve this target. So in that case, there will not be any counterparty credit risk. In this arrangement, the deal structure, there is no counterparty at the escrow arrangement. So hence I want to consider as what is the counterparty credit, the buyer default, how we have to bring into a present value also. So this is the conceptually we need to consider. So based on that one, for one iteration, I have done a 1.4195 million, but for 10,000 iteration, I have carried out in using the crystal ball. So, okay, I'll just come to here. So this is the 10,000 trials. This is the output from the, can you please confirm this one, whether you can see this Excel sheet, FY22.
Yes, we are able to see the Excel sheet. PV of earnout for one iteration.
Yeah. So this is what the mean result. So based on the 10,000 simulations, I have just arrived what is the probability, what is the mean of this all the outcomes. So I have arrived the 8.4 8,48,000.
Would using the median not be the better statistical approach, using so much statistics?
No, but in case of this, yes, I can understand from the point of view of the market multiples. Yes, we can do, but not from the point of view of the Monte Carlo simulation, because it's the multiple the paths. It will be a different.
Okay, and there's a big difference between the
using the
median and
may not give
may
not give a right picture.
Why is that so? See, because some basic statistics, what we know is, there are some conditions under which mean will work, but other conditions, there is extreme values, we prefer the median, right? And there's no situation where the median is a poorer indicator of the central value of a distribution than the mean, right? So there might be 3 cases out of 10 or 4 cases out of 10 where the mean is right, but median will always be a better indicator of the central value that it is. Yet I'm a little surprised that after using so much of advanced statistics, maybe I'm missing something, that we are preferring the mean over the median, and the median is not supposed to be an accurate indicator of the central value in the entire distribution, and being not being preferred over the mean. A little odd, maybe I'm missing something. So you're saying in Monte Carlo simulation, mean is the preferred one, right?
That is the preferred one.
I think it depends on which distribution you are considering, Subaradu. I think it's a normal distribution.
No. I disagree there.
Right,
In certain distributions, median may not suffer the shortcomings of a mean, but to my understanding, there's no distribution where the at the maximum that the mean can do, it can come close to the median. Which distribution would the mean be a better indicator of the central value than the median? At least so far I've not come across. This is a new learning for me also.
No, I think if I can just add, I may be wrong, but in Monte Carlo, what I observed now is each value is completely different. Actually, it is not connected only. So whether you use median or mean, actually mean is better, I think, because median is used. There are only few outliers. Here, every value is actually.
It is right. Nataraj, what you said is right. The distribution of the mean, so it may be less skewed by the outliers. So better to consider as a mean rather than the median.
It is the other way around. Skewed by outliers, lower likelihood is median, not the mean. In fact, that is a precise scenario in which when you see in the distribution there are a few outliers, you always prefer the median as a center rather than the mean.
Okay, depends upon the distributions also, sir. That is. Let's see.
I mean, it's just standing out.
It is the preferred. No, let's move this further.
Sure. Good.
I'll give you precise also, but majority of the things it will be based on the mean and also is based on the distribution. So let's move further. Okay. So then also the output, what it gives, it is the percentage. So almost the 55% to 60% range it is there, the percentage in this case. And also if you sometime back VBA has been conducted one kind of a frequency which is giving a results of the present value of our node at the number of frequencies. It will be frequencies. It is also gives us some kind of a output. So then also I have just considered what exactly the number of tiles output across the period. So this is the kind of output it generates in the Oracle crystal ball. So for this, we have just estimated this is what the probable contingent consideration. So it's clear, sir?
Yes.
I can move to presentation. Just what we understood this one, basically the prediction based on this formula is the previous price is the relevant for the future based on the constant directional movement and random component. What we are using this geometric Brownian motion to estimate the future prices and removing the uncertainties. So this is just a summary of the process and methods of the Monte Carlo simulation. So we understood stochastic process and random process, model many possible outcomes, larger number of simulations, use that information to make a decisions. So Monte simulation provide a number of advantages over a single or deterministic quantity estimate. Eliminates substantially reduces subjective factors. Yes. Preferred method for certain situations like contingent consideration and market performance awards. And the biggest challenge is that the volatility, and sometimes it will be a correlations also, it will be there between the variables. So that is very subjective, that when we are doing selecting the which distribution, it is very relevant. And assessment of likely behavior of each input is very difficult to justify. Typically requires a specialized software. Yes, we need to use crystal ball or maybe at least. Adoption likely heavily scrutinized due to potential for management manipulation and abuse, and difficult to corroborate the results. So this is what is the entire process. So I'm just covering the high-level overview. So this in simulation, what we are trying to do, estimate a probability distribution for each variable. So either variable, what we have defined, either maybe a revenue or maybe stock prices or maybe a beta. So we are estimating what is the probability distribution. In each simulation, you draw an outcome from each of the distribution and estimate the end result with those outcomes. Since these outcomes can come from the low end and high end of the distribution, they will be different. You run as many simulations as you can come up with a distribution of the outcomes, which you then use for the decision making. So in the earlier example, so distribution of the outcomes, so we have estimated the revenue as well as the present value of the earnout. So the outcome, we have distribution using the distribution of the normal distribution. So and we have arrived the outcome. So this is the high level overview. So I think we have covered most of the process. This one, the key input variables. So for any of the Monte simulations, so predominantly in the valuations, you may cover the stock prices, revenue growth rate, or margin, or revenue in case DCF, and revenue or EBITDA. Sometimes it will be for the purpose of the contingent consideration. That is the input variable. So, and what is the range of possible amounts for each input, and what is the distribution type, what we are going to select. I will cover a little further when what kind of a distributions it will be there, and what is the analyze the output of the variables. So there will be two types of the probability distributions. It will be a continuous probability distribution or maybe a discrete probability distributions. So Shilpa, so we have to start with the poll questions. Can we just...
Actually, this is not a CEP credit. Initially, we tried CEP credit.
Okay.
So we have not entered it. You can...
Okay, thanks. So it is everybody knows this one is a initially what we are discussing is the continuous and discrete. So sometimes it will be a normal distributions. The selection of the distributions is so important. I'll tell you here. Here this is the crystal ball usage. I've just given one screenshot. The defined distribution for variables. So sometimes in case of this, the earlier example what I've shared is the FDA approvals. Whether FDA approval is a yes or no distributions. So we have to select a yes or no rather than taking the other distributions. It will give a different results altogether. And we have to give a specific output variable, either maybe in a dollar or maybe what is the output variable, either revenue or whatever it is that. And we have to number of simulations has to be run. It will be a 1 lakh or maybe a 10 lakhs or maybe a 5 lakhs. So that is what is just basic, simple. This is a very simple, but I have seen the at least it is maybe a little complexity is there, but crystal ball, maybe it is a little easy, I can say. Okay. So we'll come to this one. So I'll just share the distributions. This we have extracted from, so you can see the screen, sir?
We are able to view your computer, the Windows, Explorer page where the file names are there. Types of distribution valuation. We are not able to see the Word document.
Now?
No, not yet. I think this, yeah, now we are able to see.
Yeah. So there is a multiple distributions where we can select. I don't know whether you can see the screen or not. Is it visible?
Yes.
Yes,
Yeah, visible. Yeah.
So there will be a multiple distributions where we can select based on the data. So if suppose it's a normal distribution, yes, we can use the normal distribution with the mean and with the standard deviation is a 1, or maybe triangular distribution. Suppose when you're using a DC of maybe the sale units, it will, we know that one minimum, maximum, and most likely the number of units can be sold in the particular year to arrive the what is the probable of getting or making a sales. So we can use the triangular distribution. So like that, it is a given example also here. I will share this document. So just to understand this one, what kind of a distributions has to be used. So there will be a two kinds of a distribution, continuous or maybe a discrete. So the continuous distributions, it will follow a normal uniform or like that. Discrete distribution, the basic example I can give you, the binomial distribution. In the binomial model also, what we are doing either go up or down. So that is a kind of a discrete, yes, either yes or no. So these are all the kind of a different distribution when you are selecting based on the data. So I'll just share this one just to understand the concept.
Sir, one question I think what we're talking about is the number of simulations, right? How do you decide what is the number of simulations, right, in a given situation?
So I'll just
maybe another way of asking a question. The more simulations is more simulations always a better output. Will always give a better output, or
no? It gives a more precise value. Precisely, it will come your output.
Okay, yeah, I think
the likely outcome it will be precise.
Okay.
The likely outcome it will be precise.
Okay.
So okay, so and also sometimes the crystal ball, what I understood. So if suppose 1 lakh simulations if you run, okay, sometimes it may 1 lakh simulations if you are selected, it may stop to certain level also, as I understood from the crystal ball. So if suppose 1,99,731 simulations it may run and it may stop also. That's what I understood, because it may stop to certain level even if you select that one. But I'm not sure about that one, but I've just tried only once. Okay, so this is the biggest. How many simulations we have to run? We will run a simulation 1000 and do it in Excel only. We will just close it. We will think, but so we can just do a simple math to get the lower and upper bound level also. And also there is one article I will just share you. How many number of simulations has to be run? So that is based on choice by test or something. It has been defined. I'll just share that screen. Okay, so this is the one example what I have given. Optimal number of tiles is quantified statistically by specifying a desired level of precision. So this is important. What is the level of precision we are looking for? For example, suppose you want to value within a specific percentage of the true value with 95% level of confidence. Jet statistics says that 95% confidence level is 1.96. If you want a 3, then it may differ. So, then if suppose for example it will be a lower bound is a minus and is a upper bound, so it will be in that range. Assume we run a 500 tiles and obtain a sample mean of 78. So the mean value, and with the sample standard deviation of $12. The calculation of our 95% confidence interval is the lower bound is the 78%, 78 mean minus 1.96. It is the what we are bringing the 95% confidence level, or we are bringing lower and upper within that range. So 76.95 and 79.05 is the valuation range, the lower and upper bound. So then I'll just share the article which I'm referring. So will you be able to see my screen?
Yes, we are able to see your screen, but we are not able to see the PDF document right now. It is in that files page.
Now?
Yeah.
Not yet.
Yeah.
Now.
Yeah.
So this article, what I was referring. So
okay.
So if you run the simulation, same example, or maybe different example. So it is standard deviation. Okay, here the level of precision what we want to see is that 0.001 per share. So how many simulations we have to run? So this is what, assuming that S is the 1.45 is a standard deviation. So if you solve this equation, it is at the 80,769 simulation minimum to achieve the desired level of precision. So we can use same thing to arrive the number of simulations has to be run.
Okay,
sir.
Okay, got it. Yeah. Thanks. I think this is helpful. Yeah, right.
No, this is for me also. It is very difficult. Okay, if I run 10,000, I'll just keep it quiet. So then we cannot justify. So finally, you can see my PPT.
Yeah.
So finally, is the mean is the answer. What is the standard error? So these are all the statistics is giving in the Oracle crystal ball, and maybe a Kutos is. I am not a statistician, but okay, I can. Whether the data is a peaked at mean or flat at mean, it means that whether how your data is represents, whether it is a peaked or it is a flat data. And skewness is it a positive or it is a symmetric or asymmetric? Asymmetric may be it is a positive. The perfect symmetry is a 0, and also it gives the range and high and low values. If you see the Excel sheet is a minimum and maximum, other databases is giving. So finally, the uncertainty concerning future outcome does not get solved in the use of Monte Carlo, rather provides a more powerful meaning of characterizing such possible future outcomes. So we can see this in the examples. So what are the future outcomes based on the different outcomes of each simulation? So we are getting that results, but we cannot resolve the uncertainty completely. So it will be always there uncertainty, but however we can possible outcomes we can arrive, and we can give a likelihood of what is going to happen in the conditions. So this is the data. This screen I have taken from the Ashwath Damodaran. So how we can select which distribution makes fit for any of the valuations based on these parameters. You discuss a discrete or it is a continuous. Then again, continuous is split into discrete and symmetric and asymmetric. So this is just for which distribution you are to select this one. Thanks
Could
for
you
attending.
please go to the previous slide, please? Yeah, thanks.
What is the cost of this crystal ball, Rican?
Not sure, sir, but maybe $1,500 or something it will be there, but I'm not sure about that. But I just did based on the what I can say 15 days try to understand the concept. But there is a one more is there, risk simulator or something that is also is there, but usage of this one is very difficult.
Rajesh,
Sir.
suppose for example, you have a convertible instruments. So I mean, the bigger challenge is if I have a uncertain variable is a function of one parameter. So for example, you say a multiple of a particular number is the desired value, then it is probably can be used for Monte Carlo.
If it is, yes, if it is a multiple, also you can use it. But so I'll give you one more example here. Sometimes it's a path dependency also it will be there. So the what do you mean by path dependency? So maybe a last year revenue, cumulative revenue of the second year we have to see. In the earlier example what I've shown, the second year revenue is the basis for the determining the total contingent consideration. So there will be a chances of path dependency. In that case, you have to run a simulation for both the years. So similarly, the correlation of the variables also it will be there. So how you are going to build your model based on that one, it will work.
No, I was coming to essentially what happens is if it is on a single variable, say EBITDA or a revenue of a particular year, it is probably, we could do, and assuming we know the distributions, because it's a difficult challenge. It's not a stock price. So where I was coming from is, for example, if you were most of the times in convertible instruments, they have this equity value or enterprise value on a diluted basis. That's the typical basis of convertible instruments potential value. In such a scenario, in such
yes, we can use it. We can use it, and the equity value. See, now you arrived at one equity value. For example, the
how will you arrive at it? How will you arrive? That's the question.
Same using the geometric bounding motion, you can arrive.
Yeah, that's the question I have. For example, I have a historical 2 years, 3 years. I'm a startup or I'm a company. It's a variety of performance. Now there are two ways. I take the free cash flow or a revenue or a EBITDA multiple today, wherever we are standing, or one I project for next 5 years. When I'm projecting next 5 years and in the terminal value, I'm using a discount rate to determine today's value. This is how typically I estimate whether my value will be at a particular level or not for each year. In Monte Carlo, how do you get this over the 5 years? Now,
okay, 5 years. Okay, understood, sir. I'll just put it across. Okay, that is as part of the one of the case study in the future. But if you see this one, which variable is having a problem? Means uncertainty. So either it will be a growth rate, or maybe your the margins, right?
Yes.
So these two is the predominantly it affects the complete valuation.
Yes.
So then we can simulate those two to arrive the what is your free cash flows
for each year.
For each year.
Okay.
So then we can arrive the what is the probability of, or maybe growth rate only if you want to make it a constant. So in your case, it may be it is not a mature company. To make it as a growth rate, it will be a constant. So then we have to do a multiple years.
Yeah, but first, the issue is how do you determine a distribution then? The problem is you have a company, say 2 years old, 3 years old. That 2 years or 3 years old.
Yeah, yeah, understood, sir. I understood your question. See, if you are determining a revenue, so revenue may not be a negative right, in the future. So then probably we can use a log normal distribution for the revenue.
Okay.
EBITDA maybe it is a negative, or margins may not be a negative.
Okay.
So depends upon the kind of a distribution what you are going to use it. So it gives the output. If suppose further you drill down the revenue further into a number of units sold, or maybe a number of services, number of ARR, annual recurring revenue or monthly recurring revenue, you further drill down. So drill down and go to that one and estimate that one, the uncertainty portion, remove the uncertainty portion and get the result. So in the revenue also, there may be a service, it will be there, maybe a products, it will be there. So the products, if you want to do it, okay, you know this one, what is the triangular distribution? Go for a minimum, maximum, and most likely. Then arrive that one. Arrive the mean results. Based on that one, you estimate the cost of particular item, or there may be a COGS, or maybe the employee benefit cost. Then arrive the what is the future value of the free cash flows.
Okay, sir.
That I think that makes sense from the point of view of the distribution selections, and also the give the right result. But getting that data and going into a particular detail level, it takes too much of time and too much of cost involved.
Yeah.
That is only challenging. Otherwise, we can select a proper distribution. So I can give you this one. If suppose I have given one example, we will continue with the same example. The FDA approval. FDA approval, you have a yes or no distribution is there. Whether you yes or no, that's it. Your data will fall under these two categories only. We cannot use the normal distribution in that case.
Correct.
It doesn't give a right distribution.
Yeah.
The result. So only to that scenario, yes or no, that's it. So I don't want to use a log normal, all those stuff there. So it's like that, sir.
Yeah. Thank you.
I just shared the crystal ball link, and also I'll just share the documents if you want, or maybe I can share in the group. That's it, sir. On my side.
Thank you, sir. Thank you so much. Great.
So I just covered the basic concepts. I just covered to get a hang on this one.
Yeah.
And we can probably
looking forward to your advanced session also.
Advanced session.
Sure. On behalf of Bangalore Valuers Association, I request Kusum to convey a vote of thanks to today's speaker.
Thank you very much, Shilpa, for this opportunity. I hope I am audible.
Yes.
Yeah. So good morning, one and all. So when I take this opportunity to thank Mr. Rajesh, I must tell that when valuation of these complex instruments are involved, one has to be well versed in quantitative theory and modeling, and especially for this option-based compensation, equity-based compensations, earnouts, and valuing this complex debt instrument. So this morning we have learned about a special topic, which is the stochastic process. We have also understood a bit about this Monte Carlo simulation. And of course, we also understood about the differential equations that are involved in this. All this knowledge is very much useful in pre-IPO valuation, and also in valuing enterprise interest, minority interest, and of course in valuing complex business contracts. It is also important to have a sound knowledge in mathematics, statistics, and economics, and of course in understanding the wordings that are contained in the contracts or the agreements that are entered into. So, Mr. Rajesh, we thank you very, very much for taking us through this stochastic process and the deterministic process. You kind of helped us in understanding. You gave an insight about the Markov property, and you also kind of told us, extensively about geometric Brownian motion. You also mentioned to us as to where these Monte Carlo simulations is useful. In litigations also it is useful, is what you have actually communicated to us. Of course, it is always useful in understanding the relative total shareholders returns. So thank you very much, Mr. Rajesh, for taking us through a very complex session. I'm sure some of us would need to kind of go back and see the recording to understand a bit more about this valuation, but we certainly look forward to the next advanced session. And I thank all the participants this morning for taking their valuable time out and participating in the session. And thanks to Shilpa for initiating this session, which is very, very useful to the valuer community. Thank you once again.
Can you tell a bit about Bangalore Valuer Association?
Shilpa, over to you for this.
Sorry, I was just, my connectivity was bad. Can you repeat?
Yeah, Shilpa, he wants to understand more about Bangalore Valuers Association.
Bangalore Valuers Association is basically all the fellow valuers were interested to share the knowledge. This is the only purpose of Bangalore Valuers Association, and we do these sessions second and fourth Saturday early mornings. Early mornings basically because all the professionals, especially valuers, are already a CA or a cost accountant or CS. So this timings no one else is doing. So we thought let this be a fixed schedule so that it doesn't collide with any of our other professional assignments. It could be any other program or it could be our office work. That is why we chose this time. And we invite more volunteers so that we can scale up the knowledge sharing initiatives. Yes, this is all about Bangalore Valuers Association. Other members can choose to add.
So we must have communicate that, as on behalf of all the valuers, I must communicate that it has been extremely useful. There has been a great learning session. It is not only that we learn through these sessions, we also interact with other valuers and we kind of share inputs, take inputs, seek inputs from them. And it has been a great learning experience from the time we have started about a couple of years back. And we also conduct not only these online sessions, but we also conduct offline sessions where we, where the best of the speakers are called, invited, who share their practical experience, which will benefit the valuer community as such. And I think most importantly, the fee for this is very, very nominal. To be a member of Bangalore Valuers Association, the fee is extremely nominal for the phenomenal knowledge that we gain on a bi-weekly basis.
Yeah. Kusum, one more thing. If anybody wants to become the member of this association, they can visit bangalorevaluers.org, where we have two types of membership. One is primary membership and associate member. The primary membership is who are the registered valuers, irrespective of whether it is SFA or land and building or planted machinery. And other than registered valuers, they can register as associate members. And once you register, and you will be added into the BVA members group, and you will get these links, okay, to participate free of cost. And you can get some solutions through the group. And if anybody wants to know the member, we have the committees and there are phone numbers and email IDs, that info and membership, and you can write an email and we will reply as well as possible.
Okay, all. Let's call it a day. Happy weekend to all of you.
Thank you so much, Rajesh.
Thanks, everyone.
Thank you so much.
Thank you.